For the last couple of years, if you even mentioned European real estate,
Yeah.
the conversation it immediately went to inflation, negative leverage, and transactions grinding to a halt.
Oh, absolutely. It was expensive, it was uncertain, and frankly, pretty painful for a lot of investors.
But the stack of sources we've got for this deep dive, they're telling a completely different story. It seems like 2025 isn't just about stabilization. It's being framed as the European real estate comeback story.
That is the core finding, and it's a monumental shift in investor confidence that you can actually quantify. So our mission here is really to trace the mechanics of how Europe goes from being this challenging market to a strategic one again, almost overnight.
And overnight feels right when you look at the headline number. We're talking about European real estate investment growing by, a staggering 23% in 2025?
Mm-hmm.
That is not a slow crawl. That's a decisive pivot.
And that growth projection, it takes us from an estimated 175 billion euros in 2024 all the way up to 214 billion next year. It's a massive injection of liquidity.
Wow.
And it's fundamentally driven by sentiment. I mean, when you pull the market, something like 3/4 of respondents expect this huge rebound in activity by the end of 2025.
Okay, but that's a huge vote of confidence.
Yeah.
It feels a little fragile, though. What's the magic ingredient that suddenly gets buyers and sellers to agree on a price? Because that gap, the bid-ask spread, that was the logjam for 2 years.
It's exactly that. That narrowing of the spread is what's unlocking everything. For, 24 months, sellers were remembering the high prices of 2022, and buyers were just staring at the high cost of debt.
Right. Two different planets.
Exactly. Now, with improved confidence, with better visibility on rates, those expectations are finally converging, and that's allowing billions in frozen capital to finally start moving.
Okay, so if investor sentiment is the mood music, let's talk about the orchestra conductor, which has to be the central banks. What allows this confidence to even happen in the first place?
Stability. In a word, it's stability. The main catalyst is the return to predictable, stabilizing macroeconomics. Inflation has been falling pretty rapidly through 2024.
Right.
And it's now getting much closer to that 2% target from the ECB and the Bank of England. And predictability, I mean, that's the oxygen that real estate investment breathes.
And predictability means cheaper debt is on the horizon. That's the engine the whole system needs.
Absolutely. Policy rates are expected to see around 100 basis points of cuts during 2025, maybe even more in the Eurozone. And crucially, this fall in long-term rates makes positive leverage possible again.
And that's the phrase we haven't heard in a while. It just means the math works again.
Yeah.
You can borrow to buy an asset, and the return still comfortably beats your cost of debt.
That's the classic mechanism, and it's what brings the big institutional players back to the table, especially for these large debt-funded deals.
Okay.
And then, the rate effect flows directly into the real economy. Lower inflation plus resilient labor markets means real wages are actually rising.
So people have more money to spend.
Exactly. And that increased purchasing power drives consumer spending, which leads the euro area economic growth to improve to a projected 1.5% in 2025. It's not explosive, but it's solid. It's sustainable.
So we've laid the foundation. We have a solid economy, cheaper credit on the way. Who's bringing the cash?
Yeah.
Because a 23% jump needs some serious firepower.
It's international capital, primarily. Liquidity is coming back fast. Cross-border investors, especially the big U.S. funds, they have so much dry powder just sitting there.
Right, capital they have to deploy.
They have to, and they're looking at Europe as a really favorable entry point now. They're attracted by the improved euro swap rates, and they're explicitly targeting value-add and opportunistic strategies.
So they're trying to get in before asset values fully recover.
Precisely. It's pretty much the final boarding call to acquire assets at a discount from the downturn.
Yeah.
But the real shift here, and I think this is the most compelling takeaway from the sources, is where that money is going. The investment hierarchy has been completely turned on its head.
It really has. I mean, traditionally, you'd see office or maybe industrial topping the charts, but the new investor surveys show that for the first time ever, living, so residential, has emerged as the most sought-after sector.
By how much?
Favored by 32% of respondents. Logistics is a strong second, but office is trailing behind in third. And this shift isn't just cyclical, it's structural.
And that structural driver is just this epic, chronic shortage of homes across the entire continent.
That's it, in a nutshell. The European housing shortage is massive. It's currently estimated at about 9.6 million homes.
Wow, 9.6 million.
Yeah, that's roughly 3.5% of the current stock. And despite all the political urgency, actual housing delivery is only projected to hit about 64% of desired levels next year. We are just structurally undersupplying a fundamental need.
And that imbalance, that just translates directly to investment resilience. It's almost a guarantee of rent stability, isn't it?
It is. We expect pretty robust average rental growth of 2.7% in 2025. And what's really critical here is the long-term divergence. Since 2010, house prices in the EU shot up over 60%.
Right.
But rents only increased by about 29%. That gap isn't just a number, It shows this immense social and political pressure building up, which proves why institutional capital sees so much stability in residential.
And investors are getting even more specific within that living category.
Oh, definitely. The niche opportunities are flourishing. Student housing, PBSA is booming. Gen Z expects higher quality living, and the universities just can't build it fast enough.
And I imagine the same is true on the other end of the demographic spectrum.
Exactly. As European populations age, specialized elderly living facilities are becoming a strategic necessity. They offer these predictable long-term income streams linked to, care economics.
And to give you a really tangible example of this opportunity window, let's look at Germany. Housing data from Q3 shows apartment prices rising 2.7% year over year. So a clear recovery. But here's the kicker. On average, those prices are still almost 10%, 9.8% below their peak in mid-2022.
And that 9.8% figure is what the institutional funds are fixated on right now. It means the market has turned, the trend is up, but the chance to buy at a substantial discount to the last peak is still there for those who can move quickly.
Okay, let's move on to the runners-up. Logistics still has incredible appeal. It was just narrowly edged out by living, coming in second with 27%. Why is the shine still in the industrial sector?
Because the core drivers are just so resilient. E-commerce keeps growing, and global instability is actually accelerating this trend of nearshoring.
Right, bringing supply chains closer to home.
Exactly. Building resilience. We saw this accelerate after the Red Sea crisis, this big emphasis on localized supply.
But the dynamics have shifted a bit, haven't they? The huge rent spikes we saw during the pandemic boom have definitely softened.
That's accurate, yeah. The market softened a bit in 2024. The average vacancy rate ticked up to about 4.4% before it stabilized. So tenants have a bit more negotiating power now.
So what does that mean for rents?
Prime rents are still forecast to rise, but modestly. An average of maybe 1.8% in 2025, which means after inflation, logistics income is essentially stable in real terms. It's more of a stable yield play now, not the rapid growth story it was.
Okay, now, office. This sector faced, existential questions after COVID, yet 16% of investors are still prioritizing it. What's the story here?
The story in office is purely about the flight to quality. The overall market might still be adjusting to hybrid work, but the demand for prime, high-quality, sustainable buildings is still fiercely strong. We actually expect leasing volumes to rise by 5 to 10% through 2025, which gets us close to historic averages, and that's supported by stable office attendance and, underlying job growth.
So if you own a tired old 1980s building in a secondary location, you're in trouble.
No.
But if you have a retrofitted, super efficient skyscraper in central Paris, you're doing just fine.
You are doing very well. The vacancy gap between prime and poor quality assets is just widening dramatically. Investors are focusing their appetite on value add and core plus assets that can be retrofitted to meet modern standards. This refurbishment activity is booming in places like Madrid, Berlin, and Paris.
And that focus on the premium end is supporting the income side then.
It is. Prime rents in the office sector are forecast to rise moderately, somewhere between 2.5% to 3% next year. It's all based on the idea that this high-quality space offers stable cash flow because it's non-negotiable for big corporate occupiers.
All right, so we've established a very compelling recovery narrative. It's driven by stability, by structural demand. But no deep dive is complete without looking at the potential icebergs. What are the key challenges that could seriously undermine this 23% growth projection?
We have to start with macro risk, and that's just the stubborn geopolitical uncertainty. Ongoing regional conflicts, the possibility of more restrictive trade practices from, say, a new U.S. administration. That's a huge risk.
So protectionism could really throw a wrench in the works.
It could. It doesn't just dampen sentiment. It creates real bottlenecks for construction materials and supply chains.
And that leads right into execution risk on the ground. If the living sector needs millions of new homes, what's actually holding up construction?
Capacity, that's the critical headwind. We're facing significant labor shortages, especially for specialist skilled workers.
Right.
This dramatically raises costs and extends timelines. In a market like Switzerland, specialist labor can cost almost $118 an hour.
That's a huge drag on any developer's profitability.
And this capacity is being stretched even further by new strategic demands. Countries like Germany, France, and Italy are ramping up industrial and defense output, which competes for the exact same pool of construction labor.
Okay, let's shift to the regulatory side, ESG. This is now a hard, mandatory financial issue in Europe, right? It's impacting valuations directly.
Absolutely. It's a pressure cooker environment. I mean, think about the complexity of the CSRD, the Corporate Sustainability Reporting Directive. That's going to affect about 50,000 companies.
And they all have to disclose their climate transition plans.
Exactly. So if your building is non-compliant, it becomes a financial liability for your tenant because it complicates their reporting.
So buildings without those strong sustainability credentials, they just face inevitable downward pressure on their value.
Downward repricing is unavoidable. It's just the cost of retrofitting. And on the flip side, compliant assets get better cash flow stability and sharper yield compression. ESG is no longer a preference. It's just critical to hitting your return targets.
And finally, there's a big one coming on January 1st, 2025, that could dampen some of this optimism. Basel V. We need to understand the practical impact of this.
Basel V, well, it's a banking reform that changes how banks calculate risk. It requires them to hold more capital. And the crucial part is that it could restrict capital for commercial real estate lending. It might even lead to higher costs for borrowers, even as the ECB is cutting rates.
So it's like an implicit tightening of the credit markets.
That's a good way to put it, yeah. It's a force working in the opposite direction.
Okay, so let's bring this home for you. The 2025 European story, it really is a recovery. It's driven by macro stability finally bringing back positive leverage. The money is flowing, but it's very focused. Living is the new king, all because of that chronic supply shortage, and it's supported by resilient logistics and that necessary flight to quality in office.
And this blend of stabilization and structural demand, it creates a very distinct strategic window for investors. But that stability, it relies heavily on managing political and regulatory risks, which are becoming, just as complex as the financial risk we spent the last 2 years battling.
And that leads us right back to the most critical finding from all of this: the dominance of the living sector. The huge shortage of homes is what guarantees rent growth and attracts all this investment. But that same shortage creates immense political pressure on leaders to do something about affordability.
Yeah.
So given that policy responses, like rent controls, often make the problem worse in the long run, what happens to the investment case for the living sector if political risk becomes as volatile and as unpredictable as the interest rate risk we just moved past? Something to consider as you dive deeper into this comeback story.